Thank you for watching the Economic Mechanics lesson. Here, you'll learn about four key relationships between the US dollar, commodities, the bond market, and the stock market. We're going to begin our lesson with looking at the key relationship between the US dollar and commodities, but first, let's take a look at the history of our monetary base. This is a chart of our U.S. monetary base from 1918 to 1971, as reported by the St. Louis Federal Reserve. In other words, it is how much money the government is printing and injecting into the monetary system. In 1971, President Richard Nixon eliminated the fixed gold price, causing our monetary system to break down. The world was concerned at that time, but we assured the world that we had a good track record and would not print too much money. As you can see, there was just over $70 billion in circulation in 1971. And this chart illustrates our monetary base as of 1987, the year of the stock market crash. The red arrow indicates 1971, when we told the world that we would not print too much money. Well, as you can see, we did continue printing money, and in 1987 exceeded $200 billion in currency in circulation for the first time ever. That's triple our monetary base from 1971 in just 16 years. Now let's take a look at the year 2000, when we had the Y2K scare. Once again, the first red arrow represents 1971. The second red arrow represents 1987, when we had the stock market crash. Well, in the year 2000, we were told that we may not be able to pay for things using debit cards or credit cards. This meant that we had to take out a lot of cash to make purchases. We were told that computers weren't going to work. Well, the government continued printing money, and they tripled our monetary base once again to over $600 billion, this time in only 13 years. This chart represents the year 2008. Well, we go back and we see the first red arrow, and that represents 1971, when we said we wouldn't print too much money. The second arrow, 1987, when we had the stock market crash. And the third arrow, the Y2K scare. Well, between 2000 and 2008, we had a war, and that cost quite a bit of money, and we continued to print more and more money. This time, in 2008, as of December 31st, we increased our monetary base to just over $850 billion. Let's take a look at 2009. Once again, the first red arrow is 1971, the second, 1987, the third, Y2K, and the fourth, December 31st of 2008, when we had about $850 billion in currency in circulation. In 2009, we passed a stimulus package which cost a lot of money, and the Federal Reserve continued to print more dollars. This time they doubled our monetary base to $1.8 trillion in only 6 months. Also note that since 2000, they once again have tripled our monetary base, only this time in 9 years. Now, more currency in circulation means weaker dollars. The world knows this and has grown very concerned and have been talking about a global currency. And as we close out the year 2010, we can see that our monetary base has eclipsed the 2 trillion mark. Now, it doesn't take a financial genius to realize we cannot go on this way. Now we begin our economic mechanics lesson by focusing on the dollar as our root. That's because there's an inverse relationship between the dollar and commodities. And that makes sense because, for example, if we have 1 ounce of gold, and that's say $1,000 per ounce, and the dollar declines in value or has less purchasing power, we're going to demand more of those weak dollars for that same 1 ounce of gold. Same is true for oil and other commodities. There's also a relationship between commodities and the bond market. Then the bond market is related to the stock market, and that we will get into shortly. But first, we're going to focus on the dollar and commodities. This chart illustrates the dollar in green and commodities in orange back in 1989. Now you can see as the dollar rises, the commodity prices are falling. And that makes sense once again because if the dollar is rising, getting strength, and commodities are priced using dollars, well then, as the dollar rises, fewer of those dollars would be demanded to purchase a unit of commodities, whether it's a barrel of oil, an ounce of gold, or any other commodity that's out there. Now, before I discuss the relationship between commodities and the bond market, it's important to first understand how the mechanics of the bond market work. Basically put, if you have a bond price that's equal to $100 and yields $10 in interest every year, then the bond yield, or the interest rate, is 10%. Now let's say that the price of the bond falls to $50, but it still pays interest of $10 every single year. Now, the interest rate would be equal to 20%, since $10 is 20% of $50. If the bond price rises to $200, it still pays interest of $10 every year, but the interest rate falls to 5%, as $10 is 5% of $200. So, as a bond price rises, interest rates fall, and as a bond price falls, interest rates rise. There's a direct inverse relationship to this, and that'll be important for understanding the commodities portion. This is a chart of commodities in orange and bond prices in black from 1989. Bond prices and commodities usually trend in opposite directions. You can see that relationship here by the blue lines that connect the two. First blue line, you can see a top in commodities with a bottom in the bond market. Second, another top in the commodities and another bottom in the bond prices. The third, we see a top in bond prices and a bottom in the commodities. Again, usually they travel in the opposite direction. Now, we know that interest rates and bond prices have an inverse relationship. So if we look at the next chart, we should be able to look at it where the commodities and interest rates will be moving in the same direction. Let's take a look. And then here we have it. The purple represents the 10-year bond yields, which is the inverse of the previous chart, which had the bond prices. The orange line represents the commodities market. And you can see commodities and treasury bond yields usually move in the same direction. Now we take a look at a chart going back to 1964 to 1987. Again, the commodity prices are in orange, and the treasury bond yields are in the purple or the pink. We can see that they generally move in the same direction. They don't move in the same percentage, as we can see by the spike up in commodities in '73, but they generally move in the same direction. Now we look at the bond prices in black and the Dow Jones Industrial Average in blue. This from 1982 to 1989. Now we can see from this picture that bond prices and the stock market usually trend in the same direction. With one exception, bond prices have a tendency to peak prior to the stock market, and we see this during the 1987 stock market crash. The next chart, we'll take a closer look at the 1987 crash to understand how the bond prices peaked prior to the stocks. Here is a close-up of the 1987 action. We see where the bond prices peaked prior to the stock market. The bonds peaked in spring of 1986, but it didn't start to drop until spring of 1987. The fall in the bonds warned that a top in the stock market was coming, and we can see in October the stock market collapsed. So where are we now, 2011? Let's begin by taking a look at the dollar. Now the first thing we recognize when looking at the dollar is that it's been in a long-term downtrend, but most recently in 2008, late 2009, and late 2010, we hit some major bottoms in the US dollar. But in order for us to consider this a major reversal, we'd like to see us take out the 200-month moving average indicated by the red line at about 92. Once we do that, we can look for further evidence to consider whether or not the dollar is actually going to break out or continue on with its downward trend. Another positive sign for the US dollar is seen when we take a look at the stochastics. Recently, we just got a bullish signal when we saw the black line cross over the red. That would indicate that the coming months ahead should be strong for the dollar. The MACDs and the histogram are not indicating very much at this time. Both are flat. Usually the stochastics will be the first to give a bullish signal, so we're going to look at the MACDs and the histogram over the coming months or quarter for a confirmation of the bullish signal given by the stochastics. Now let's look at a chart of the commodities. A close look at this, we can see that in 2009 we hit a bottom, and we've been responding very nicely since then. Since then we've broken through the red line, which is the 200-month moving average, and then we've also busted through the 50-month moving average, which is the blue line. Now, in order for this trend to continue, we'd have to see a reversal in the dollar, and right now it looks like the dollar is gaining some strength. So evidence suggests that we should see a break here rather shortly, or a consolidation. A review of the stochastics is showing us that this trend is a bit overextended. Both lines are over 80, which indicates overbought territory, and the black line is getting ready to cross over the red. This is confirming the action that we're seeing in the US dollar right now, and shows us that this trend may be coming to a temporary end or consolidation. The MACDs and the histogram are still showing considerable strength, although, as I said earlier, the stochastics are usually the first to give signs of weakness. So we're going to watch the MACDs and the histogram very closely over the coming months if the stochastics do indeed cross and give us a bearish signal. The last time the commodities were trading in this range was back in 2006. I drew a black line across the peak from that year, and it appears as though this would be a logical spot for the commodities to take a break this time around. The trend for commodities looks very strong, and I expect it to continue. But if we're going to see strength in the US dollar going forward for the short term, I would expect the commodities to pull back somewhere in this range. The 10-year Treasury has been in decline for quite some time now. Interest rates have been low, and in 2009 we saw a bottom, and at the end of 2010 we also saw a bottom. Interest rates have been rising rapidly since then. Rates right now are up against the 50-month moving average represented by the blue line. Right there, that would represent potential resistance, and that would make sense as the commodities are also challenging resistance right now. So we're going to look at both to challenge resistance and see if they can break out or if they're going to pull back and consolidate just a bit more. Both of these trends look very strong going forward, and I expect interest rates to start rising rapidly, if not now, then toward the end of 2011. The stochastics are confirming the rise in interest rates. We received a bullish signal back in 2010 when the black line crossed over the red, and we've been rising ever since. The MACDs and the histogram have both followed the stochastics with bullish signals of their own. The blue bars of the histogram have been rising for several months, and we just received the crossing on the MACDs. This indicates further strength in interest rates, which means interest rates could be going higher. If this happens, we could see pressure on the stock market to come. Now let's take a look at the Dow Jones Industrial Average. We see that we had that massive fallout back in 2008, 2009, and since then we've been rising rather rapidly, and for the first time since 2008 we are trading above the 50-week moving average indicated by the blue line. We see too that the volume has been healthy and mainly to the upside. The stochastics, however, appear to be a bit overextended. They're over 80 and look like they're about to cross. Now that doesn't mean they can't stay over 80, but if they do cross and begin to fall below 80, that would indicate that there could be further weakness going ahead. The MACDs and the histogram still look very strong and show no signs of any weakness, but if the stochastics do cross and turn negative, we're going to look here for confirming signs of weakness. But overall, it looks like the trend will continue, at least for the short term. For 2011, my initial target for the Dow Jones Industrial Average is 12,700. Now, I think we're going to hit that sooner rather than later because I think we got some trouble in store for the later part of the year. But for now, we're going to be optimistic and go with 12,700 on the Dow Jones Industrial Average.